This is called the allowance for doubtful accounts. Contra account, allowance for doubtful accounts. That's what we're looking at right now on page 365 of your text. So the first thing we want to do is take a look at page 365, the big picture exhibit 7.1. And what you're going to see is a very familiar transaction. And there's three events. ATS earned $14,000 of revenue on account. They collected $12,500 cash from AR, from accounts receivable. And then they adjusted its account to reflect management's estimate that uncollectible accounts would be $75. See, whenever you're selling something on account, you have to take into consideration that not all the money is going to come in. Anytime you're selling goods or services on account, there is a strong possibility not all the money is going to come in. And that's the whole purpose of accounting for receivables, chapter 7. So the first thing we want to do is understand what a contra account is. Contra in Spanish means Italian. Contra in Spanish means opposing or offsetting. So if you look at this right here, the allowance for doubtful accounts, this is what's known as the contra account. This is a contra account right here. And change that in red, highlight it. That is a contra account right here. That's a contra account. It offsets the accounts receivable. The contra account right here, the allowance for doubtful accounts, offsets the accounts receivable right here. This is obviously debit, and this is credit. And up here is debit, and this is, and that's credit, AR. This is the accounts receivable account. That's debit and credit. This is the allowance for doubtful accounts, debit and credit. And so when they put in $14,000, they increased the accounts receivable by $14,000. They were offsetting it with a contra account. Contra meaning opposing. They're offsetting it by $75. And the whole purpose of trying to figure out the net, well, let me rephrase that. The whole concept of trying to determine how much money to put down here is under the guidelines of allowance for doubtful accounts, allowance for doubtful accounts. And what I mean by guidelines is there are a couple of methods in the textbook to determine how to calculate allowance for doubtful accounts. So the first thing we're going to do is go to page 368. Over here, page 368 is the percent of sales method. So what happens is whenever you sell something, you are going to figure out that you have to determine some of the money is not going to come in. So if you look at page 368, we're going to look at the percent of sales or percent of revenue method. And this is what happens is when you sell something on a credit, you just automatically determine that 1%, 2%, or 5% of the money is never going to come in. So I'm going to start with the second paragraph down on page 368, second paragraph down. At the end of 2013, ATS estimated uncollectible account expense to be $75 of service revenue on $14,000. So we see that right there. We have service revenue, $14,000, it's accounts payable, and we have it booked under revenue as well. Service revenue, $14,000. And the allowance for doubtful accounts is $75. In 2014, ATS wrote off $70 of the 10, which was later recovered. ATS therefore experienced actual uncollectible accounts of $60 on service revenue of $14,000, an uncollectible accounts rate of approximately 0.43% of service revenue. ATS could apply this percentage to this 2014 service revenue to estimate the 2014 uncollectible accounts expense. In practice, many companies determine the percent estimate of uncollectible accounts on a 3 or 5 year moving average. So what they're doing, so what's going on here is that ATS has to make estimates. This contra account right here is nothing more then an estimate of how much money is going to be, how much money is not going to be paid based on the accounts receivable. And what happens is once you make this estimate, you have to go ahead and readjust things as it changes. So if we can go to page 369 for a second, the next page over, page 369. And what you're going to see, I'm just going to walk through a very simple exercise. As you could see that $10 off the money that they reported was never going to come in for ATS did in fact come in. So if we can take a quick look at page 369, Exhibit 7.2, page 69, Exhibit 7.2. What happens is, if you look at event number 4, it says ATS reinstated a $10 account receivable it had previously written off. So what happens is you have to ask yourself, once you make this estimate once you estimate the uncollectible account using the percent of revenue method, what happens when money comes in that you didn't think that was going to come in? What do you do? How do you fix that after you've written it off? And what you do is event number 4. They reinstated $10 account receivable had previously written off. So what you do is go down to allowance for doubtful accounts and look at transaction number 4. What they do is they're adding it back into the equation, adding it back into allowance for doubtful accounts. And then at the same time, they're increasing allowance for doubtful accounts by $10 and accounts receivable by $10. And then in event number 5, what happens is ATS recorded the collection of $10 from the reinstated receivable referenced in Exhibit 4. So in event number 5, they're decreasing AR and increasing cash. That's how you bring it back onto the financial statements. You just put it back on there under allowance for doubtful accounts and AR, accounts receivable, and then make its way through to the cash account. That's how you make it a readjusting, or I should say an adjusting entry dealing with cash dealing with an accounts receivable that you have written off. Now we're going to move on to, so that takes care of the first one, estimating uncollectible accounts using the percent of revenue method. The simplest way to explain this is that most people develop a very straightforward strategy, using percent of sales method. For example, you may say you do $100,000 in sales, all on credit. It's all on credit. Everything you sell is on credit. And you figure allowance for bad debt. You use a best estimates of, say, 0.03%. 0.03% is what you allow for bad debt. So what you would do is 100,000 times 0.03, and that means $3,000. Okay, so that's what you're going to have. $97,000 is what you have coming in. So the way you're running your business using a percent of sales for uncollectible accounts is you figure everything you do, 3% is not going to pay. 3% of whatever the amount is. $100,000 in revenue, which is all on accounts receivable because it's all on credit. 3% is not going to pay. That means $3,000, and that means $97,000 is what you have coming in. Now, of course, this is not going to be an exact science. It may be a little higher, maybe a little lower. But again, looking at page 369, event number 4, and event number 5 is how you make the adjustments at the end of the year based on that. Now, the whole purpose of this is so that when you present your financial statements to someone, especially your income statement and balance sheet, they can understand that this is going to be pretty accurate, meaning that you sell $100,000 worth of goods or services, and you can reasonably assume that 3% is not going to pay. So that's the whole purpose of this. Otherwise, if this is wrong, your income statement is going to be wrong, meaning the amount of money that you have booked under accrual accounting for revenues is going to be off. Also, your accounts receivable on the balance sheet is going to be off. Because what happens if it's really, 12%? What happens if you're selling used cars, for example? And your used car dealership, you start catering to people with no job, no income, no questions asked financing. Well, you're going to have bad debt going a lot higher than 3%, meaning a lot of people aren't going to pay their car loans back to you each and every month. So if you're saying that you sell $100,000 in vehicles and that everyone's going to pay you on credit every month, and you're selling to people who have absolutely no money, your bad debt is going to go up. If it goes up to 12%, well then $12,000, you're going to have, that's your allowance for bad debt. Your new amount is going to be $88,000. So from $97,000 to $88,000 is what your accounts receivable is going to be. And the reason why is, again, because you've had an increase in your allowance for bad debt. You're selling to people who have a higher propensity for not paying. So the next one I want to move on to is using the percent of receivables method on page 370. Page 370, percent of receivables. Now please bear in mind that most businesses, they're going to have cash sales and credit sales. Might be 150,000, 125,000, for example, in cash sales and 100,000 in credit sales. And so what we have to look at is total revenue is going to be this right here. Your total revenue is $225,000. It's credit, and credit is, of course, receivables. So what you have to look at is the cash sale. Obviously, if you sell something for cash, you're not going to have a problem collecting it. But if you sell something on credit, you're going to have a problem collecting it. So what you do is we want to figure out percent of receivables. $100,000 is going to be what we have on receivables. And if we figure, say, 9% is going to be allowance for bad debt. We're using the percent of receivables method, and we figured everything we sell on credit, 9% of the people are not going to pay us. So what we do is net realizable value. What is the real value of our accounts receivable? Is it 100,000, even though we know 9% of the people are not going to pay, or is it something different? So what we do is we take 100,000 times the 9%, and we know that it's going to be $9,000 is going to be the contra account. Below bad debt. So allowance for bad debt is $9,000. So the net realizable value is going to be equal sum 100,000 minus the allowance for bad debt, 9,000. $91,000 is the real value of our accounts receivable. So 91,000 plus the cash, copy cash, sales. So our total account sales should be, or revenue, should be 216,000, not 225,000. So it's going to be 216,000 instead of 225 because, again, the allowance for bad debt based on 9% of accounts receivable is how we get this number. That's on page 370. Now we're going to move on to the direct write-off method on page 372. Page 372. I'm going to load page 372 up. I'm going to use the direct write-off method on page 372 because I'm about to run out of time on this video. So please watch the third video for how to use the direct write-off method. Thank you.